My name is Michael Guyad, publisher of the Lead Lag Report. Please join me for our the man, the myth, the gorilla, I guess, JJ. So, JJ, for those who are not familiar with your background, just talk about who you are, how did you get interested in markets, your career progression, and what are you doing now?
Well, thank you so much for having me on, Michael. Really appreciate it. I'm JJ, VWAP Trader One on Twitter there, and I started in the business in 1993. I started in Vancouver, BC, which was the offshore portal for unregistered stock and Reg S stock coming from offshore tax havens into the United States markets. Little did I know then that I would be at the epicenter of some of the most interesting stock stories of the 90s, like Brex Minerals, and just had all sorts of characters rolling through Vancouver. I started out selling advertising to hedge funds, promoters, and public companies, so they could get leads. Back in the day before the internet, you had to get leads the hard way. They mailed them in, just like Glengarry Gun Ross. And then the internet started, and I became a trader on a trade desk at one of the sort of nefarious brokerage firms in Vancouver. And my job was to liquidate large insider stock positions for the people who promoted the deals, for the people who financed the deals, for the insiders, and also for the people who funded those development stage early companies. Having no formal education other than 4 years of microbiology and immunology, I started at the bottom. I started as a geek on the trade desk. The only thing is I had a lot of clients who did nothing but liquidate positions at 5% commission. So very quickly I became one of the number 3 producers in the firm in the top 10. And so that was my life for 20 years, was basically being the executing trader for large early stage investors and liquidating their investment into the retail flow when the buying came in. So I developed relationships with all the wholesale market makers in New Jersey that you guys love to hate. There were tons of them back then. And what they'd do is they'd show me bids all day and I would control the supply. Therefore, we could control the price of the security and distribute. Now, I started out in the pink sheets in the OTC bulletin board, which is basically the sewers of the stock market. And I worked my way up. So I was, to a better class of client. And at the end of my trading tenure, I was working on NASDAQ small cap and full blown NASDAQ stuff. I did a lot of stuff. My specialty is doing the short squeeze. I'm an expert in cross-border clearing between Europe and the United States. And, I'm sort of, I was kind of like the concierge of the small cap markets. You needed something done, you came to me, I'd find the person to do it for you if I couldn't do it myself. So I did a lot of that. I traded for lots of crazy people, arms dealers, large hedge funds, small hedge funds, all sorts of just crazy people. I've been around maybe 200 reverse mergers and IPOs, and I've been the executing trader on those. So order flow and mechanics of markets and how they work, and now structure, because I had a heart attack in 2012. At the age of 44, I had a heart attack, had a quintuple bypass, and I had to do something a little bit more, something less stressful. So I chose retail trading. And then I had to figure out how to trade when you can't cheat. And it's been sort of a passion of mine, and we're teaching people now. So that's what I'm up to now. And we have our podcast, which Michael was on a little while ago. And we were very lucky to have his knowledge come and talk to us. So that's basically me in a nutshell.
I have to say you're refreshingly honest to trade when you can't cheat. I'm going to hit on that because I think that's an interesting underlying thread, certainly around the way retail views Wall Street. But let's go back first to that time when you mentioned you were generating leads. How much of Wall Street back then was purely sales, business development versus actual analysis, and how does that compare to today? Because I think the reality, unfortunately, is that most of this business really is marketing.
Oh, yeah. Most of this business is marketing. It always has been. It just changes forms. And we've gone from a commission-based revenue model, which what I started out in, and now we're in an asset gathering revenue model. And it's completely changed the way markets do trade. And it's fascinating to see. You'll see the S&P 500 all of a sudden magically just run out of supply at certain levels. It's like the selling just shuts off automatically, and nobody wants to sell. Nothing for sale in Tuscany. So you see that, and I grew up in markets where there was always supply, right? There was always, if you just show them show me a bid, I'll hit it. I don't care. We're always liquidating, right? Because we'd get our stock at ridiculously cheap prices to what retail was paying. We're always in at a discount. So that's changed a lot. And the analyst back then was a paid analyst. You had a NASDAQ small cap stock at, $5, $10, and you would pay somebody 10 grand who was a CFA or something like that to write a favorable analyst report so you could use it at marketing materials to get retail investors to come and buy the stock. It made it look credible, right? Now all of that stuff is gone. The high pressure sales tactics and all of that, that's all completely disappeared as the commission based revenue model, kind of went the way of the dodo bird. And, now it's a thing, but people still are, I noticed there's still quite a lot of spec money out there playing in these markets.
How has this is a way to frame it, this sort of shift from commission-based revenue to asset gathering-based revenue, how has that altered some of the internal dynamics of the market and incentives from your perspective?
I think it's greatly affected how supply works. You look at the large, asset gathering firms, BlackRocks and Vanguards and State Street. They have positions. They have their positions in Apple and Microsoft are big enough to choke a dinosaur. Like you've got 1 billion shares of Apple amassed. The stock maybe trades 90, 80 million shares a day. There's no way you could sell 1 billion shares. If they came out of their position, that thing would be sub pennies, right? There's just not enough liquidity. So these people have a huge long-term time frame. They got a 30-year time frame to hold this. And what's done, and also with the share buybacks because of low interest rates, we see supply being sucked out of DTC. And so sometimes the market will sell off quite violently, right? Because of margin call selling, because so many of our speculators are hopped up on cheap credit. And then all of a sudden the sell orders abate and the thing will just rip all the way back up. And we have these huge ranges with not that much liquidity because large size will move price drastically. So I think we have more volatility because a lot of concentrations of large positions. Sometimes these big companies, less than 1% of their float trades on a daily basis. So what I'm kind of worried about is what's going to happen when, somebody needs to sell 200 million shares of Apple. I'm not saying that I'm not trying to put in panic or anything, but where are we going to get the liquidity, right? So those are the things I'm looking at. And I noticed that, the S&P has some pretty crazy ranges and the order books are very thin. So big orders just move this thing drastically. And there's so much momentum players taking advantage of the fact that supply just runs out like it did today. And, at 38.87 down there, it just shut off like a switch. It's incredible to see the dynamics of how supply just, shuts off. And then boom, as soon as we run out of supply, demand is created pretty quick.
So I think it's interesting, right? Because the part of the argument around why speculation, you can argue, is good in markets is that it creates a degree of liquidity. And correct me if I'm wrong on this, but I'm going to make the argument that the number of speculators in markets has probably never been so high. Back in the day, in the early 90s, mid 90s, you had to pay a hefty commission to buy and sell.
Oh yeah, right? Yeah. I mean, I wouldn't get out of bed for less than 3% on of commission, right? I mean, there's no way I would have done business for less than 3%. I was 3 to 5% commission. My ticket charge was $25, right? As a trader, so now you have people trading for free, or they're clipping pennies. It's quite amazing. So that
does that dynamic, you think, increase liquidity or make it worse? So the reason where I'm trying to go with that is that, again, I go back to this idea that in theory, the more speculators you have in any system, the more liquidity you have because there's more people involved, right? But at the same time, if you have a lot of, let's call them what I term many times uneducated speculators, right, in the market, it actually might be the exact opposite because you can have these air pockets as people don't know what
Oh
they're
yeah.
doing, end up creating these dynamics. Talk through that about.
Well, I've noticed that there was a couple of weeks ago where we had a gap in the overnight where actually nothing traded in a period in like a 15 point range in the overnight. There was absolutely no trades because there was nothing in the order book to actually execute in this range. And it was fascinating to see how we were above that days. And then when we came back into that area, there was responsive buying because shorts were trapped in that area. I do find that, I mean, it's a liquid market for retail traders. But if you're trying to move size, now you're a portfolio manager. A lot of these stocks are kind of thin. So if you go in there and you're executing trader, I'm not sure if you have an executing trader or if you outsource your execution or you have something in house, for them to work a position and work a size position without moving the price up on yourself, that takes a little bit of skill in this market. I'm not sure if you would agree.
Yeah, no, and obviously, I think the proliferation of ETFs also kind of adds a whole nother wrinkle to that dynamic.
Right, and also the amalgamation of market making and wholesale market making it's become so monopolized. You have maybe three or four firms that get probably 70 to 80% of the incoming order flow into North American markets. In the old days, the Nasdaq would have a red book and it's about the size of a Bible. Now you can see there's much less independent market making and wholesaling out there. You know,
So
um,
does you think that justifies some of this narrative around us versus them that you often see in the retail community, right? Because if you don't have
yeah,
a lot of
yeah,
competition, right, it's natural to
yeah.
blame the those that control the bulk of the flow.
There's always, the markets haven't changed really. I mean, it 200 years ago or 100 years ago, they had those pools, right? They had investment pools and trusts that would bull stocks and things like that. If you read the stories, nothing's really changed. I always look at the market as, these big size players, they're working order flow because a fund manager needs to move a position or come out of a position. And I kind of put it like, there are these big, huge trucks, semis going down the highway at 100 miles an hour, and we're kind of trying to jump in between. We're kind of getting in the way. I don't really view it as an us and them. The liquidity providers are there so we can buy 10,000 shares of a stock and not pay a $2 range to buy 10,000 shares, right? They'll short it to you if they don't have it, right? And that function of providing liquidity, a lot of people don't understand that that's going on. And that wholesale retail relationship, especially if you're trading futures, is really, really important. I used to be the them, so I don't feel like us versus them. I'm like, listen, let's figure out how size trades, how they move the market, so we can swim next to the shark instead of into its mouth. For me, I definitely think that. I think companies are the way they're spending money. The words fiscal responsibility have gone whistling through people's heads for the last 10 years now. You have companies that are losing money, like drastic amounts of money, and they're still, they're selling stock with cheap financings to keep the lights on. It's not like their business is actually keeping the revenue going and keeping the lights on. So I think more active, you're gonna have to dig deep and sing for your supper now, because the free money train starting to break, and people just aren't buying anything that they see. They're going to be a little bit more selective. Maybe that's going to start happening, and we'll have to actually, dig down and do some more research on the companies that we buy, because a lot of people spend more time researching the refrigerator they're going to buy or the barbecue they're going to buy than their investments. And, we've had an incredible run. So, maybe it is time to, put on the work boots and actually dig a little, right? I don't know what Michael thinks about that. He's more in the bird's eye view of that because he's actually doing it. I'm a very, very short term trader.
No, no, no. Well, you're hitting on. I've used a similar analogy. People would rather watch cat videos than read a prospectus.
Oh my
Right.
God! Yeah, exactly. Yeah. No,
Right.
yeah, no, yeah.
No, and
Exactly.
it's really
It's
unfortunate. So
true.
I just got
It's
off
true.
I just have did a segment with David Lynn of Kitco. So the video is going to be
Oh,
up later
cool.
today,
Cool.
and we were talking about. So he gave me this analogy. He said his barber was talking to him about how his son was basically saying that he wants to be an influencer, something along those lines, and that he wanted to be a FinTwit influencer. And it was talking about all these stats around Tesla and talking about cars and all these things he was reading. And I'm hearing this, and I was ranting on this, saying, "Look, I have no problem with speculators and obviously people getting involved in markets, but it's not meant to be fun. It's a serious endeavor." And we're in this bizarro world, which I've called uneducated speculation many times, where, to your point, people don't really do true due diligence anymore. And never mind the fact that they don't do due diligence anymore, they assume that the last several months are what's going to happen in the future, right? Almost one for one. In other words, yes, there's these behavioral biases that we're all familiar with, like recency bias and a little bit heuristic and confirmation bias, but it's so unbelievably more prevalent now than ever before in history. And going back to market structure, which we'll touch on, that's got to have changed the way markets operate compared to the 1990s.
Oh, definitely. Yeah, it's. I mean, the '90s were just. I still remember, the So's Bandits, and those retail traders coming in the '90s, and some of them did well, but my goodness, the amount of just click and go. I mean, when I was watching those meme stocks like GME and AMC, and I'm a huge. What I look at is dollar volume. I mean, how much dollar volume has a stock traded that day, which means how much can I liquidate into that dollar volume? And man, Michael, my God, they were trading billions of dollars of dollar volume as the street came in and took them. You could have sold 800, 900 million dollars worth of paper in a day into that volume, and they wouldn't have even noticed. They would have just taken it. I've never seen liquidity like that in those stocks as when the meme people came in and took them. My God, I've never seen that. I was like, where were you guys when I had 300 million shares of worthless paper to sell? It's just amazing. I've never seen anything like that. Well, I mean, electronic trading, you got to remember that the electronics and the algorithms and all that stuff, they are executing per a business plan, right? So order flow is created by agenda. Like, say Michael needs to buy 10 million shares of a stock for his portfolio, right? He will have his executing trader work that order, and they'll use algorithms and execution software, which is fast and efficient, right? So the business is still the same. The algos and the electronics just make it much more efficient, right? Because they can execute much quicker than a human being. They don't get emotional. If you tell them to stop there, they'll stop there. If you tell them to buy here, they'll buy there. They'll stand in there. And now they have artificial intelligence that can sense order flow. And I think it's fascinating. The percentage, I'm not sure. But because I mean, I yes, the S&P futures, and for that, I know that it's mostly all inventory. Just inventory between wholesalers and large prop traders that's moving this thing back and forth, according to news events and things like that. But I don't think retail, in futures and things like that, maybe retail 20% of the equation. And in stocks, it depends on how actively traded that stock is and how popular it is.
But presumably there's got to be a feedback loop, right? Because the algorithms are acting off of every single thing from the flow perspective that's happening, which comes from retail too, which then they respond to, which then retail responds to, right? So you end up having this dynamic where it's all one shit show.
Yeah, and that's what happens when we get into a chop. We'll get into chop because there is no size pushing one way or another, and these things will be banging around. And when it's choppy like that, that's just when I decide to stay out, go grab a coffee. you know, because it's kind of like Rock'em Sock'em Robots. All these algos are just banging into each other. Like, they'll take a trade. Like, an order will come in, it'll trade, move the market one way, and then another order will move the market the other way, and it'll just because the book will be thin, it'll just kind of bang back and forth.
Let's define for the audience maybe a little bit more what exactly market structure means, because a lot of people use that term and it sounds very sort of generic and amorphous. From your perspective, what is market structure, and how is that changed over the decades?
I've just been studying market structure and what we call these things TPO charts, which are a market profile chart, something that I was introduced to by Jim Dalton and Peter Stadelmeyer, and their work was it was very instrumental for me because when I started trading, I couldn't read candles because my job was to create the candle chart. And I look at a candle chart like a party invitation. I make it look good. You guys come, I can sell you paper, right? I can sell you stock. So I never knew how to look at candles and dojis and this and that and all the patterns and everything. So I stumbled across market profile. And what it does is it's a two-dimensional visual representation of transactions, just like a candle chart is, but it will show you very clearly the structure of the market, like where the inventory is, short term, long term. It'll also show you where people are trapped short, where people are trapped long, and it'll show you like the ranges, like a daily chart. And it's basically a half-hour candle chart. And if you look at my Twitter, I'm posting them all the time. A lot of people will call them alphabet charts because they have A, B, C, D, the lettering. But that's what we call market structure. Market structure to me is a structure of the transactions that have occurred, and from those structures, I can deduce whether where the inventory is and if people are trapped long or short, and if there's supply or not.
And is that does that do you find that gives you an edge? Or, I mean, how does that actually factor into making better decisions?
It gives me a hell of an edge because I know where the shorts are trapped, so I know where buying is going to be if I'm short a market, so I know where to cover. I know where to initiate longs based off shorts being trapped and supply running out. We teach very, very simply in our room. It's all about supply. If there's supply, you can go short. If there's no supply, then you've got no business going short a market. There's no supply because you need supply to push prices lower. And these charts clearly show you when supply has run out. It's quite fascinating. I only discovered them in 2012, 2013, and I'd never seen them before. But after spending years with them, and I was kind of trapped in the middle of Canada in Saskatchewan. It's like minus 50 there for 6-8 months out of the winter. So I got pretty familiar just sitting and watching price action for about 18 hours a day.
And I'm curious, has that market profile, has the way the market profile itself, how that's structured, I guess, how has that evolved over the years as you've been studying this?
I took it from the book, from Peter Stadelmeyer's book and Jim Dalton's book, Mind Over Markets, and took those theories and applied them to shorter time frame trading and also for swing trading. There's a very, very interesting concept called balance for longer term traders. The market trades in a bracketed area. When it breaks out of that area, up or down, you double the area to get the target. And Michael, I know you're quite learned and you're a CFA and things like that, but it's so simple, and the accuracy of it is just absolutely. It'll blow you away how accurate it is if you know what to look for. It's a lot of things that when I talk about it, people will go, "Now, JJ, I think you're smoking something." But if they come in and they actually watch a session, and I'll be able to tell people, okay, it's going to go here, then it's going to go here, then it's going to go here. And if it doesn't go here, this is what's going to happen. And you can kind of prepare yourself for different scenarios if you are a trader. And what I do is I use the market profile and then I mix it in with a 5 and a 1 minute candle to show where short-term inventory is. So we can see when supply is running out, so we know when to cover a short or when to initiate a long. And conversely, when people are trapped over a level, they will become supply. So if you've got 6 hours of trading above a level with no upside, those people are going to start getting tired and they're going to start breaking, and they will create the supply to push prices down, and that's when you can short. It works really quite nicely.
So it's kind of fading the liquidity of the crowd in the moment, right? So from that
exactly
right. So from that perspective, I am curious if this is maybe an interesting thought experiment. If the advent of retail traders en masse actually makes it even easier to make money from that, because you can see more of the groupthink that happens around a particular level or stock, whatever it may be.
Definitely. It's like you let VWAP or a standard deviation or a 9 EMA or something like that. Everyone's executing around those areas, so you watch for how price reacts, when it gets down to that area. So say if a market breaks VWAP and is headed down to its first standard deviation. Well, how it interacts with that first standard deviation, like the ES just did, it looked under the first standard deviation for a 1 minute candle, came back up. So we know that supply under 39.12 had exhausted itself and the trade is to the upside. It's quite fascinating.
All right, so I want to keep going on this liquidity discussion for a moment because liquidity is always set by the marginal buyer or seller, right? We know that, to your point, this is why it's challenging for institutions to en masse really execute a large block order because there's just really isn't that much institutions own while traders trade, and traders are a smaller percentage than the institutions. Um, does the liquidity profile of markets here worry you at all? And I say that because there is seemingly a lot of illiquidity in a lot of parts outside of equities. And I can make the case that you look at treasuries, illiquidity. You look at the dollar, shortage of dollars, illiquidity. Volatility is directly tied to illiquidity. Talk about the liquidity of the markets overall here, and if that makes you maybe trade smaller or get more defensive or more aggressive.
I definitely think liquidity is going to be a very big concern going forward. As long, because I read in 2021 that there were $800 billion borrowed against equity portfolios being used for speculation and such. And then you saw that, larger high net worth individuals don't sell their stock. They get loans against their position. They don't have to incur capital gains. All of these things are wonderful as markets are going up and interest rates are low. And, there's cheap money out there, and that cheap money is being used to prop up markets. When when the music stops, that lack of liquidity it makes me nervous. It does make me nervous. It I'm a guy who always I've always been a liquidator. My very first boss, when I asked him, "Hey, chief, we've got 200 companies as clients. Which one of these deals should I buy to make some money?" And he's like, "JJ, you don't buy stock, you sell it." And I just started in the business, and I was like, "What do you mean?" He goes, "You don't buy stock, you sell stock." I'm like, "Well, how do you sell it? How do you if you don't buy it?" He goes, "You get it for free, you idiot." Right? I mean, there's a thing called S8 stock. There was, founder stock. You get stock at half a penny or a tenth of a penny. People will give you stock to work on deals. And ever since 1994, I've never actually paid for stock in my life. And I've never actually wired money into a brokerage firm. You sell stock and take wires out. So I've always been a liquidator. And so when I see low dollar volume, low trading volumes, that kind of makes me a little nervous. Like Apple traded 76 million shares yesterday, maybe 77. That's not a lot of trading, right? And it was, on the Friday, these positions are hugely held. Like Vanguard's got 1.2 billion shares, BlackRock's got a billion, Buffett's got 900 million shares of this stuff, and the thing only trades. If it breaks 100 million shares in a day, that's a big day for Apple. So those things do worry me because I've seen markets. I traded through 9/11. I traded through the long-term capital thing. When they shut the market down and sent us home. The flash crash. I've traded through all of these things, and I've seen what happens when markets go bid off. And retail investors really don't understand the concept of bid off. And when markets go bid off, they can drop like crazy, like during COVID. And that lack of liquidity is it kind of worries me. Yeah, it worries me. While we can keep the plate spinning up in the air, I'm okay. But once a few start crashing, uh, you know, you always want to make sure you have a chair when the music stops.
Yeah, and that's I think what where this gets to be interesting, right? Because illiquidity in markets creates the conditions for a crash, just like leverage, and over leverage creates, and yeah, there's a relationship there, obviously. But part of this is also sort of this idea that okay, so if you have an illiquid market, and if what we're seeing is an illusion in terms of the liquidity of markets, well, the Fed can't come in and and counter that as easily because inflation is so elevated, right? So I've got to assume that from a market structure perspective, the dynamics for really nasty air pockets are very different than even like the flash crash of 2010 or other periods where there was just no bidding right underneath the surface.
Yeah, and those situations rectified themselves quickly, because we were in the beginning stages of that cheap money. Now we've kind of peaked, and I mean the S&P went from 4,800, it dropped 1,000 points, and we were telling people in our room in October and November that 22 was going to be a different market and there was going to be supply. And as soon as we got into areas where we started taking out swing lows, we started getting those tumbling margin calls because the market had been taken up by speculators. It's not grandma buying 100 shares of IBM and putting it in her safe deposit box for the next generation. These are speed daters. They are not long-term players in our markets, but yet they are playing with huge amounts of money, massive amounts of money. And there are people. We have a fellow in our room, and he just sold his partnership of a large sort of investment partnership / prop firm. And these guys were trading 5,000-10,000 E-mini contracts, and that's the kind of size that they were trading. And so there are people out there who are pushing a lot of really big money in fast time frames. And you can see that because when the markets go bid off, I mean, we just had a run up to 4,300. We're back down to 3,900, in just a couple of days. Because we launched off 37.75 on short positions, and we still have 4 short positions that are clear underneath us, and that's why we looked under 38.95 and came back up this morning. So, these things are. If you're going to trade short term, you should know the dynamics involved and what's going on, so you can trade on the right side. And if you're not, I tell a lot of people who are like, I want to day trade, and I'm like, is it really for you? Can you watch this? Do you have the time and energy to put into this? If not, you're better off thinking longer term and sitting down with your financial advisor or being your own financial advisor or whatever you need to do, to maybe think in longer term timeframes, because these moves back and forth, I've seen people just get completely wiped out trying to catch these moves because the ranges are just so big and unforgiving.
Is there again, I'm thinking just from a market structure perspective, right? Is there anything that you've seen that would show you the whites of the eyes of a margin call that could be coming soon, right? Because margin calls, I put that tweet out with these headlines around energy trading, margin calls, $1.5 trillion. I'm not even tracking that closely, but it kind of sparked this tweet for me in the morning, this idea that, it would be ironic if the next wave of selling in equities is driven by margin calls in the energy space.
Could be.
Right, because a margin call in one sector is never just margin call isolated as just one sector. The whole thing about margin call, it's entire portfolio.
Exactly, and as well as I do that. What is the one thing we hate on the other side of the desk is wiring money, right? Sell something, right? So when you start getting margin calls, it's like a snowball rolling down the hill. It gets bigger. Those energy sector margin calls could drive selling in other products, definitely. And right now I'm looking at at the S&P, and I think as soon as we start taking out 38.65 in the in the futures, that is a swing low, and if we take that out, we'd be looking into the 38.35 area. So I'll be using those swing lows to see, because when they crack, that's when I notice that there is margin call selling. And as an equity trader, I'm always interested in T+2. I mean, back in the days, I don't know, Michael, if you're at a bit of a much higher level, but back in the day, they used to say, if it doesn't hold settlement, you've written wood, and you got wooden tickets, you got sellouts coming. Yeah, Jersey, in Jersey they call it writing wood, right? You get wooden tickets, and that you have clients that are just flipping in and out of stocks, and when the time comes to pay, they don't pay, and if markets don't hold settlement, you can get rolling sets of margin calls, and that does create supply. Definitely.
Yeah, and I think part of that margin discussion is obviously a discussion around options trading. Speaking about liquidity, when it
Yeah.
comes to options trading, personally, I've always found it uh, crazy that we got to a point where people are gambling on options which expire in a week. And I say gambling purposely because there's a lot that can happen from a just pure noise and randomness perspective when it comes to weekly options. But I'm curious to hear your thoughts on how options trading has maybe evolved from the early mid '90s as a market maker. Has that added sort of an added layer of difficulty when it comes to analyzing liquidity, market dynamics, things like that?
Definitely. That's why I don't trade options at all. I'm a pure futures trader, and I just focus completely on the order flow of the ES because I'm what 54 now, and I do have a heart condition, so I'd like to keep my stress really low, and I trade one product. I know it like the back of my hand, and that's what I stick to. But I do think the options markets and the dealers, how they're hedging, and all that stuff has affected the volatility. I don't know the intricacies of that market because I don't trade it, but I definitely think there's that, and then also you'll use hedge. You'll see hedge funds using options to paint a picture, right? They'll like buy a bunch of puts with somebody, and somebody will think there's a large put buyer. If they're trying to do the reverse and pick up a position and maybe scare out a seller, that kind of thing. Um, so there is all of that I've seen with what hedge funds do and things like that. But yeah, I definitely think they've created much more volatility. Um, but I stay away from options quite a bit. I'm
Yeah, I mean, most people should. I mean, because it's like you never want to bet against time. Going back to the old Rocky Balboa quote, right? Time is
Yeah,
undefeated, right?
yeah, no
So
kidding. Oh my God, yeah, it's true. And I tend to stay away from markets that I don't have a really strong understanding of, because if you don't really know what's going on, you're the sheep at the table.
So that's a good point. So, and this, and I'm going to relate it again to the uneducated speculation and a broken market structure. If you talk to a lot of people, you do the podcast, you're involved in the trader community. Um, do you really think that people really have a grasp of what's happening underneath the surface, or is it everybody
No.
just looking at charts?
Everyone's looking at charts. Nobody understands that the business creates the chart. That's because unfortunately people don't get a chance to work in the business, right? And unless you've moved 5 million shares in a day, or you've had to cook the books at month end, so you get paid, you're not offside, all those sorts of things. A lot of people I notice, like retail traders, will blow their accounts up at the end of the month because they don't understand month end is risk off, right? And they'll go balls to the wall at month end and blow themselves into smithereens just because they don't understand. That's when the end of the month is when you're supposed to be protecting the profits you made all month. And so things like that, I talked to a lot of people. We've had 6,000 people come through our room since we started it. And it's very, very few people that understand the actual business that's creating the chart that we are trading. And we're trying to people understand that a little bit. Now they don't have to know the dirty details of how to sweep a book, or how to induce short selling or any of that stuff. They don't need to know how to do that, but as long as they understand how markets work a little bit, they can kind of trade with their head screwed on the right way.
Yeah, I guess that's the question, right? This idea of understanding how the market works. The market used to work based on fundamentals primarily. Right
Mm-hmm.
now, the market works much more based on technicals, you can argue, and
Oh yeah.
maybe more noise, right? So, talk about how
Oh
that
yeah.
dynamic has impacted the ability to self educate. Because in a world where people are not true investors, they're not focused on fundamentals, they're purely focused on a chart. There's really no need to self learn because everybody can just simply draw lines.
Exactly. And we have a lot of people, and a lot of people have done well just trading that if they have the discipline to adhere to just I'm going to take this trade. It's an A plus setup. I don't know why it's going to work, or the premise of why the trade's going to work, but it works 8 times out of 10, or 6 times out of 10. I mean, and that's cool if um, if that's okay with you. A lot of people are okay with that, and as long as they're doing well, I have nothing against that. I'm the kind of guy, like, when I was 5 years old, I took my bike apart. I didn't put it back together for a few months, but I had to see how it worked. And I've always been like mechanically minded. So I'm a mechanic when it comes to stocks. Like, companies will pay me quite a bit to do short squeezes, to orchestrate a short squeeze and set them up. So all of that stuff, the mechanics of it's always going through my head. So I can't turn that off because I was raised in the industry. Now, you don't need to be raised in the industry to be a successful retail trader, as long as you have discipline and money management skills, and you're only taking your A+ setup, so to speak.
All right, so that's interesting. The point about orchestrating a short squeeze, right? Which is, whereas before it was maybe a select group of institutions that would orchestrate it. Now you've got that, online with social media, right? Orchestrating a short squeeze.
Oh
Um,
yeah.
yeah, talk about that, because that's an interesting. On the one hand, I'm always conflicted myself on sort of this idea of a collective trying to force some kind of a move in a particular asset or stock, because it creates a distortion, at least for a moment in time. Although, of course, obviously the excessive shorting, you can argue, creates the distortion too. But in the world of all this social media and retail trading and group orchestration of certain stock price movement, how does that really break market structure? Because you don't really know if price is truth anymore.
No, and that's why I don't look at price to be truth, right? I always say don't follow price. It's like following that pretty girl down the dark alley after the club closes. You're going to wake up in a bathtub full of ice missing a kidney. But you watch to see how price behaves. And there's a lot of signs you can see using market structure, even using a candle chart, to know when the shorts are starting to trap themselves. And those orchestrations are done for many reasons. One is if a company's trying to get a financing done and there's a predatory financier who's shorting the stock to keep the price down to get a better price on the deal. That's why you can do a short squeeze. It's been around since the 1800s when Vanderbilt squeezed Harlem Railroad up to $1,000 a share. It's always been there. The short squeeze always been there. Tesla was the last famous one, and it's funny that Tesla was done 100 years to the date of the Stutz automotive short squeeze in the 1920s. I don't know if you knew that, but very, very similar. The Tesla squeeze, we were telling people at $300-400 not to short the thing, because we said, three to five, 5 to 7, and once it gets over $700 a share, it's going to 1,000. And that's exactly what happened. And there was no float. There was no float. All the Bailey Gifford had all the stock locked up, over in Ireland or Scotland, and off they went. But yeah, short squeezes are something that I learned how to do, and a lot of clients would ask me to help. It's basically nothing more than just controlling supply of the insiders, to affect whatever operation and carry out whatever agenda that they want. To set a high price for a financing. And sometimes back in the day, you had a lot of predatory short sellers. You had the Asensios and the Fieros and guys like that. I don't know if you remember those guys, but they would prey on companies, and they were, because back before 2005, naked short selling was fine, right? You didn't have to have a borrow. So when they changed the rules when Reg SHO came by in 2005, that really changed a lot of the way prices behave and how stocks trade.
And I know it's legal, but it is a form of manipulation, if only for a
Oh yeah.
moment in time.
Oh, definitely, definitely. And that's why I don't do it anymore. And I get paid quite a bit to do that, or people will offer me. But no, it is there are things when I always say if you put $800 million on a table, what's going to happen next is definitely not random. Um, you know, in this business, if there's $800 million on the table, it belongs to the person who picks it up. That's how these people think. And I'm actually writing a book about my experiences and all these crazy characters that I traded for. There is a common thread of them. They are all, these people who are, insanely wealthy and do deals. They'll take a company public, a small cap Nasdaq or whatever, and they'll work on the deal for a couple of years and cash out $300-400 million. And they're pretty ruthless, when it comes to accomplishing their agenda. And these are the people that I was trained at. That's why I have this sort of, this mentality. When I look at something, I'm always looking to see how the move was made or who the players are, that sort of thing. It's always been fascinating to me.
But so I'll term that legal manipulation, right? Just to keep going with that conversation, right? So presumably it's much easier to manipulate something short term than long term, but
yeah,
right. But the long term is a rolling series of short terms. So
exactly.
using the Tesla example, so if there's an organized short squeeze or degree of legal manipulation to get that going, well, then now on that squeeze, now the momentum traders come in that are algorithmically driven, perhaps, right? And that creates then the self-fulfilling uptrend that makes Musk one of the richest or the richest person in the world. So I only say that because there is this, and this does, I think, speak to the frustration around and creates this us versus them dynamic, which is that, well, the only way you can fight fire is with fire, right? The only way to counter manipulation by the big boys is to do the group manipulation on the Reddit side or social media side. But I go back to, I don't think that's healthy, because that's not what you shouldn't be thinking about manipulating price. You should be thinking about what's the underlying fundamental reason for putting capital at risk.
Exactly. Now, you're a CFA and you have a longer outlook. You have much, much larger capital reserves than the average Joe. So, you will think like that. A lot of people get sucked into the, those quick profits. And you're right. There will be a time when people will go, okay, wait a minute, this company since inception has done nothing but lose money. Why is this a viable business and why should I invest in it? The company is burning, $300 million a month, and the CEO's flying around on a on a Gulfstream. Where's all this coming from? People eventually will start asking these questions, and I think the investing landscape will change, because we're kind of in that Flintstones mode now, where whose baby is that? What's your angle? Okay, I'll buy that, right? And when the free money train comes to a close, that's going to start going away.
I know you talk about cryptocurrency. Speaking about liquidity, liquidity is an interesting topic when it comes to cryptocurrency trading, and obviously there's no real fundamentals you can exactly point to when it comes to the cryptocurrency space. I see some tweets that you put out, JJ, about Bitcoin. I'm curious to hear your thoughts on how the liquidity discussion transfers over to cryptos, and in light of that earlier discussion around margin calls, how the illiquidity of cryptocurrency may end up being having more than sort of may end up having a spillover, right, to other parts of a portfolio which have nothing to do with digital assets.
Yeah, definitely. Crypto, while I do track crypto and I have levels, for Bitcoin that I do publish, I'll come up with balance zones and give people targets. If it does this, it'll go here, kind of thing. I don't actually trade it myself because, like I say, I have a heart condition, and it's just a little wild for me. And I know the ES market, so I just stick to what I know. But I do think, crypto is a very highly leveraged product. And I remember when you were on our podcast, you actually spoke to that, saying that, you can get, 100 times leverage in Cyprus, if you can't get it in the States because it's unregulated. And I'm not bashing crypto. I don't want to get a bunch of hate mail. I think it's great. And if you can make money off it, that's wonderful. But just please make sure that you are, that you do understand that these markets are highly leveraged, and there are people trading out there with massive, massive amounts of margin and leverage. And if they do get margin calls, you will see runoff selling in other asset classes. Because if you get if you wake up to a 20% haircut one day in one market, it's going to start affecting other things that you're holding.
Right. No, exactly. That's and that's been a thesis of mine for a while, right? It goes back again, a margin call in one area is never just isolated to one area.
Yeah.
Just like a crash in one area, it's never really just, which also just kind of, I just wonder with all these, extreme tail events happening in other asset classes outside of equities if we're going to see equities next in that context, because again, it's never just isolated to one thing.
Exactly. I'm hoping, that, we can weasel our way out of this situation, and, things will sort of stabilize a little bit, but just in case they don't, let's all remember that, to have some protection. And, I talk to so many people, and they're like, it's going to go to 100,000. It's going to go to this. And, and like, where did you buy it at? I'm up 40%, it's okay to like take a little bit of profit, and let the rest ride, just make sure that, you do book some profits, because you're never going to go broke taking a profit. Don't be too greedy, that's my big thing to people. And if you want to keep some and hold it forever, that's fine. But make sure you pay yourself, because, that's what this whole business is about. Now, I remember you spoke about store of value and things like that. And I don't know enough about, digital currencies to go on about that and say, is it going to be a store of value and things like that? But the way it behaves, not just yet, maybe,
That's an interesting sort of discussion maybe for another space, because there's Mike Venuto, who's the CIO of Toroso, has many times on record said that he thinks blockchain is going to take over the ETF industry because it gets rid of a lot of the intermediaries, which I think makes a lot of sense as a technology. But yeah, we'll save that for another conversation. But JJ, final thought or final question on my end: what's the biggest thing you learned in being a liquidator that you still use as a lesson for today?
One thing is, I've always sold into strength. And, the one thing I've learned in 30 years in this business is never underestimate the other guy's greed. If you're in markets and, you are trading, watch your back. There is always someone that is going to be liquidating. So, don't get married to trades. Be able to admit you're wrong really quickly. And I find that that's really helped me with, the best risk management I've ever found is actually humility, to admit you're wrong and get out and, wait for a clearer path.
Yeah, I think that's still in a bear market, but the bull market will really be for equities when that's at max, when there's a blow off in humility. Right? I think that's the way to frame it. So again, everybody here, please make sure you follow JJ. Always a pleasure listening to you, JJ. I always like talking to guys that have been in the business for a while, that have that real sort of historical perspective. And everybody enjoy the rest of your day. And thank you, JJ. Appreciate it.
Thank you so much. Have a wonderful evening.